let's explore a little bit about the bond market and the bubble in the bond market that you've spoken about, and particularly the impact of negative interest rates. Would you want to just sort of explore that and help us understand why that's so much of a difficult phenomenon to get around?
Well, when you think about negative interest rates, what does that do? Owning a bond with a positive yield is an asset. If all of a sudden that bond has a negative yield, the central bank has basically turned an asset into a liability. And that is the epitome of a hot potato bubble, because the only way you'll make money owning a negative yielding bond is hoping to sell it at a higher price to somebody else that then takes that bond at an even deeper negative yield on the hopes that they'll pass it on to somebody else. So it's the ultimate bubble. When you have high yield junk bonds in Europe trading with a 2% yield, that is not reflective of the credit quality of that company. No, that is a big bubble. When you have in the US CCC rated companies, so just above essentially bankrupt D, with a yield of 6%, that is giving you no room for error. That is not an appropriately priced bond. That is a bubble inflated bond. And if the world's assets, whether it's stocks or antique cars or paintings or any other collectible, trades off the level of interest rates, well, then you can argue, if bonds are the ultimate bubble, what does that mean for asset prices elsewhere? And that is something we have to watch. And just to touch upon European bonds, we've seen some leakage in that bond bubble in Europe. I mean, only a few months ago, the German 10-year bund yield was almost minus 60 basis points. Now it's minus 18 or minus 19 basis points. It's actually getting close to zero. And that is with no shift in the amount of QE that the ECB is doing. And if anything, in March, the ECB front-loaded QE because they didn't like the rise in rates that they saw. So the world's bond market's already adjusting here. I mean, the 10-year US yield started the year at 0.9%. In 3 months, it went to almost 180. 90 basis point move in 3 months. That is essentially almost 4 rate hikes by the Fed that the market put in place. Imagine the Fed raising rates 4 times in 3 months. You would say, oh my God, that's crazy. Well, the bond market has adjusted. The bond market is saying to the Fed, and the bond market in Europe and Japan are saying to central banks, you are no longer in control to the same extent that you used to be. We don't like it when inflation perks up. We don't like it when you run the economy hot. Therefore, we are going to adjust interest rates for you. So while we pay attention to what central bankers are doing, the bond market is already moving in front of them. The bond market's already speaking up for themselves. And if inflation this summer continues, and it is not so transitory, you will see another leg higher in longer term interest rates.